Welcome back. You're watching The Money Show right here on ET Now. We took you through how you should report incomes in your income tax return. We took you through the HSBC Large Cap Equity Fund. And now here's another very important aspect on investment, and that is annual reports. This is the season where you will be getting a lot of annual reports from various companies that you've invested or bought equity shares of. What do you tend to usually do with your annual reports? I'm sure reading them would be something that would not be on your agenda. You'll probably just skim through it or glance through it. Well, on this edition of the show, I would like to tell you about how you can make the most use of your annual report, how to self-assess these reports to understand what to make of it and whether that company continues to be a prudent investment option for you. To help me analyze the annual reports across sectors and across companies, I will be joined by a very special guest. And I'm talking about not just your P&L and balance sheet, I'm talking about audit reports, management discussion and analysis, and even the notes to account. So let me bring on board then Chirag Jain. He's a senior fundamental analyst with Sykes and Ray. Chirag, thanks so much for joining in on The Money Show. You know, very often we have this tendency that when we get the annual report from a company, ya to raddi mein jata hai, ya it's just lying around for a very, very long time until your house help will decide to throw it in the dustbin. So firstly, explain to our viewers what exactly is this importance of this 100-page document that comes once a year.
Okay. First of all, annual report is something like, for example, if I want to decide if I have to invest in a company or not, I go through a certain documents, I get to know about the management's comment, auditor's opinion, the financial statements. So all of this data, you find it in a book called annual report. So before reading an annual report, basically what you need to know what to look for into an annual report. Unless and until you know what to look for in an annual report, it's just gonna be a chaos for you. Now, if you see, like few decades back, annual reports were nothing but a very few thin documents, you know, followed by chairman's letter. So that were
just
mostly
simple paper documents,
simple papers and all of it. But today, with all the extensive disclosures and everything, it runs into more than 200-300 pages. So now the major question, like I want to invest in a company, it's not easily answered because the annual report itself contains so much data.
Yeah. True, of course. So let's say if I am interested in a company and I manage to procure the annual report.
Yes.
If I have to identify which pages of that annual report will tell me the future story, what should I read?
So there are basically five important, you can see the five important headings in an annual report which you need to actually go through. First one is called your management's commentary. Second is your auditor's opinion. Then comes your balance sheet, profit and loss statement, and cash flow statements.
But in the management commentary, I mean, let's say if it's my company, I would always like to paint a pretty picture, right, to prospective investors. So then as an investor, how can I understand what part of the management commentary to rely on and what not to?
Yes, I would say management commentary is basically done by the top management, all the CEOs, MDs and all of that. So basically they give you a gist of what has happened in the company in the previous year. But the thing over here is they always tend to boost only positive numbers and they tend to play down on the negative factors. Here you have to actually go through other data also to critically examine whether what management has told you is painting a correct picture of the scenario or not.
Okay, let's take it one by one. You mentioned, we talked about management analysis. Now let's talk about balance sheet. In fact, here are some very interesting pointers as well about how to decode the balance sheet. One of them was current assets and current liabilities. If your working capital reduces suddenly. The other one was, of course, the higher liabilities. Let's take it one by one then.
Okay.
Importance of balance sheet. What numbers should pop out then in the balance sheet? Let's take that one by one.
So balance sheet basically it consists of assets and liabilities. Assets is what you own and liabilities is what you owe. So when you see there's two more important part of the balance sheet. One is your debt and another one is your equity. Equity is basically what is your own investment in the company, and debt is what you have borrowed. If you see over a trend, a particular trend where debt is continuously increasing as a vis-a-vis your equity, that's not considered to be a good sign. So one
higher
such exactly. So higher shareholding, higher shareholders equity portion versus your liability. The company which has a higher equity holding compared to the debt holding in a company, it's perceived to be a stronger company.
Okay, from a purely balance sheet perspective, it's
Balance sheet perspective,
So if in
yes.
case you see your debt, the debt line item suddenly rising over a period of time,
Yes.
that is basically a red flag
Yes.
in the books. Okay.
Yes.
Let's also talk about the entire current assets, current liabilities. That too is a line item in the balance sheet.
Yes.
And
Yes.
sometimes these numbers as well radically tend to change.
Yes.
Should that as well be a red flag?
Yes, actually. So current assets minus current liabilities is what's called your working capital. So higher your working capital, higher is what it's saying is you are efficiently running your company.
Yeah.
If your current liability suddenly increases more than your current asset, which means then you'll tend to borrow more money from outside, which will only lead to more interest payment and lesser profits in the future years. So I would say one thing to look out for is the working capital cycle.
Yeah.
In the number of days should be a reducing cycle over a period of time, which is considered to be a very strong point over here.
So again, a trend. If there's a
trend,
stable
yes.
trend, it's
A
all
trend.
right. But if the trend radically changes, then it's a bit problematic.
It's a
Okay,
problematic.
let's talk about profit and loss. Now, this was, of course, the balance sheet, which, by the way, is a very stable statement. Let's talk about profit and loss account. Over here, very quickly, again, what should an investor or a prospective investor first look at?
So first you should look at is the sales revenue,
Yeah.
which is the major thing. So basically companies sell products or services.
Right.
Over a period of time, what you should look at it if the sales are rising or not. That is one of the healthiest indicator for any company. If sales are rising, which means the company is selling more and more
All
products.
else being equal.
Yes, actually, and the company is following a good strategy, and that's considered to be a very good positive sign of the company.
Okay, rising sales volume,
Rising
steadily rising sales.
Yes.
What else in the P&L?
What else? Other than sales, the second factor, important factor is operating
Cost.
margin.
Yeah, margin.
Operating margin. So operating margin, your operating margin is nothing but your sales minus cost of goods sold. Cost
Okay.
of goods sold are like your raw material expenses, employee expenses, rent, etc. Operating margin should also be rising vis-a-vis your sales. If your company is reporting an increasing sales but a diluting operating margin over the year, that's just saying that the management is not working out properly or the expenses are not in control of the management, which is not a good sign.
You've also mentioned here, don't see a sudden rise in profits as a positive sign. Why is
Yes.
that?
So sometimes in the operating margin, sometimes in the net profit of the company, there's other income included also. So what is other income? Basically, other income is other dividend income, interest income, etc. Or whenever a company sells a unit or something, it tends to include that part in your other income. And if you see a sudden rise in profits, and which is because of other income, it is not considered to be a good sign.
Okay, in fact, I'm going to come to the red flags as well, but before we do that, I just want to talk about cash flow.
Yes.
What we see in the profit and loss account could show a different picture as opposed to what we see in the cash flow statement.
Yes.
In fact, the cash flow could sometimes give a more verifiable picture. So do you
Yes.
believe that would be a more important statement as opposed to P&L?
Yes, I would say that. So there's a theory like net profit. You have a net profit at the end of the year, every year. But net profit is something you cannot deposit in your bank account or you can just carry and spend around on something. For that, you need actual cash. So for that, you need to look out the cash flow statements, because there is where you exactly come to know whether my net profits is actually turning into a positive cash flow
Cash
for
flow,
me.
yeah.
And cash is what I can actually spend or deposit in a bank account
Or pay
something.
dividends.
Yeah, pay
Yeah.
dividends. So I have to look out for the cash inflows and positive cash flows over a period of time.
Is again a positive sign.
Yes.
Okay, all right. Now, of course, the most important, and that is the red flags. This is something that everyone is worried about, because
Yes.
if a share price doesn't go higher, it's okay. But when it tanks is when, of course, it will spook a lot of investors.
Yes.
So now
Yes.
let's talk about those red flags. I think you've shown us a couple of examples as well, and I'm going to show that right here. Could you give us some examples on what sort of red flags? Like, for example, you flagged off this one. What exactly does this mean?
So here, this is one of the footnotes of the annual report. What
This is something you have analyzed, an
Yes.
example. Okay.
So what happened over here in this company? They took a lot of borrowings.
Okay.
And so they have mentioned that we have taken a lot of borrowings. But what has happened over here? They have taken that borrowing to fund their subsidiaries.
Okay.
So that has increased. On your asset side, what has increased is loans and advances. Now, in the footnote, what they have not properly mentioned is, what they have mentioned is, we have committed to provide financial support to subsidiaries, amount not ascertainable. So
Okay.
you don't know where the money is going. They
Yeah.
just simply told you, okay, we have borrowed so much, we have put it in our company and it's gone to our subsidiaries. To whom it has gone, why it has gone, amount is not mentioned. And suddenly, after a couple of years, you come to know that money is gone.
Yeah.
So they are not accountable for that. So this is a very big red flag if you find such statements in company reports.
And this is in the notes to accounts.
It is in the notes to accounts.
That
yes.
means that tends to give you a good picture as
Yes.
well of what's happening. Okay, let's bring up the other example then that you have flagged off earlier as well. This is in the notes to accounts, how to spot the red flags. Where else? And this is the second example. This is in fact directly in the balance sheet, and we have
Yes.
two examples here. So what is it that you're observing here in an example?
So continuing the previous point over here, the company, if you see in 2017, this was the borrowings. Now this is in crores, okay?
Yeah.
This was the borrowing. Borrowings, if you see, have increased 5 times, okay? And that's the most worrying sign for the investors. Like that's not a good sign. Okay, then I would look on the asset side. What have company added? Why have the company done the borrowings? What I find out that company has had no loans given, and which has suddenly increased to 3,300 crore, like from zero to almost like. So entire borrowing was for
Has
this
gone
part.
to a loan,
Yes, and this money has gone out to some other company. So now I'm worried if a company has taken a huge debt and the money has gone out and the company is not providing me any kind of explanation, management is not telling me what it has gone for. This is a very big red sign.
Unlike if it's gone for, let's say, a fixed asset or you know something productive, it's just gone to loan, which looks like quite a you know, there's no explanation as well given. So this as well is a red flag. And I think you have shared one more red flag, and that is, I think, for non-recurring items. We'll just bring that up as well. We'll just wait a moment till that comes up. Okay, no, this is in fact balance sheet trends, reserves and borrowings. What exactly
So
should one see
exactly
here?
in the balance sheet on your liability side, what you have earned over a period of time, the profits, if you see, all of that is added to your reserves. Now, if you see the spot over here, over the period of time, the reserves are actually coming down.
They are decreasing.
In fact, in the previous year, 2019 itself, the reserves become negative. This is a very big negative sign. But you see, the reason over here is the borrowings. The borrowings have increased tremendously, and the reserves have gone down. So this is not a good sign. I would not want to invest in such a company or look for such a company which is having a degrading or negative reserves and increasing borrowing.
Okay, all right. Decreased from 39,000 crores all the way to negative 5,500 crores. This is a very, very big red flag. And finally, of course, on one-off items, recurring items. Again, some examples on such items that you have seen, which again would catch your attention.
All right. So, for example, there's a company doing business. It has a lot of units. Okay. In sudden year, it sold one of its units. Now, the amount what they have sold is they have actually shown as an other income as a profit. Now when a common investor sees that, what he sees is, okay, now the profits have increased 10 times. But what they fail to realize is this includes other income. That other income is a non-recurring item. It is only a one-time event. This will not come again. So that tends to show a higher profit, and media also, if you see, the profits have increased from 100 to 1,000 and all of that. Yeah, without actually telling you that, okay, it was a part of other income which was included in the 1,000 crores. So we should look into that also, the details.
Okay, so I hope this has made all our viewers wiser there on how they can read annual reports. These are some more very interesting red flags, in fact, that are being spotted. Chirag, thanks so much then for joining in. And folks, we have a weekend coming up, so I hope you're going to make wise use of that and read all the annual reports that you have received over a period of time.